Hello everyone and welcome back. My name is Greg Furman, market analyst here at TraderPlanet.com, and this is the Forex weekly outlook for the week of December the 19th, 2011. Now we're getting into some of the final presentations for 2011. Certainly an interesting one this week, and I'm going to change things up a little bit. What you can see here is I have a split screen. I have the US dollar index on the bottom. I have the S&P 500 continuous contracts on both, sitting on the top, and what we're going to do is some comparative analysis to see if we can gauge how the global economy looks going into the end of 2011, more importantly in these last two trading weeks, what we can expect. Now the S&P 500, I've talked extensively about this, that I suggested that we have a repetitive pattern that we would sell off in and around just above the 1250 area. That is come to fruition. Now, looking at this, we're looking at potential targets for not just next week, but maybe even the year end. When we look at this, I have the long-term crossover from Vantage Point, and I have one other indicator in here alone, the predicted long-term difference. What I want to do is be able to gauge the different. First of all, what I want to do is a comparative analysis to the major global markets against the US dollar, and I want to look if those other markets and the US dollar are overbought or oversold. When we look at the S&P 500, the long-term crossover is again getting ready to cross just like it did before after the European summit, after a period of consolidation. We're going into that period of consolidation now. I do expect some further choppiness in the equities, but I also expect them to probably move lower based on what I'm seeing here, the long-term crossover to the downside, the predicted long-term difference sitting at trend-ready levels to the downside, not the upside. There's a number of different theories that come into place when people are looking at trend lines, wave theories, this kind of thing, but the reality is when we look at it in correlation to the other markets, we see that there's a pattern here, and we see it when we compare it against the US dollar. There's a pattern there also. So when I look at this, this tells me that the dollar is going to continue to strengthen after probably a modest pullback. We're not really overbought here. We have room to extend. But the S&P 500 looks like it's just getting started. Now, a target here, you can see I have this line drawn down here at 1150. That is the likely area that I would target, barring any kind of intervention again from the Fed or any more jawboning out of the Eurozone that everything is okay. When we look at this presentation based on the correlations, I think you'll probably agree that the economies of the world are not okay, and it doesn't bode well for the equity markets. Now, when we look at this again with this predicted long-term difference on the S&P 500, it's warning that we're heading lower. We can see repetitive patterns here before on the predicted long-term difference. When it's hit this level, we've started a slow descent, but the market has moved from the 1250 down to the 1150 area. Now, the downside potential on the S&P 500 could be greater than 1150 this time, because again, we've been up here multiple times and we're failing yet again. When I look at this, I'm also bringing in other markets into consideration that are highly correlated to the S&P 500 and moving away from the single analysis of looking at a basic chart and candles and ranges and trend lines. I'm using it to correlate to the other markets, which I think is very important. Now, during this period of consolidation on the light sweet crude oil, I showed in the past weeks the high correlation we have to the S&P 500, and the two are basically moving together. Light sweet crude oil after this consolidation period is now breaking significantly lower. We're not oversold yet. We are mildly oversold, but we have room to extend. And if we look at this previous candle, or excuse me, this previous area back here, so again, plenty of room to the downside. We look at copper to gauge things on a global basis, and we can see in each one of these the correlation it has to the US dollar index. Copper is now crossing to the downside, and again, very similar to what we saw after the last European stuff in October. So copper starting its descent down, and again, we are not even remotely oversold on copper. Another leading indicator to the global economy. I talked extensively last week and recommended to get out of gold because gold looks like it's getting ready for a big move to the downside. And again, you can see the correlation. The dollar goes flat, gold goes flat, the dollar breaks higher, gold breaks lower. The gold is getting moderately modestly oversold, but I believe that there will be a bounce higher, and I also believe that there will be a lot of sellers sitting there waiting to get short on gold. I don't see a big future for gold in 2012, at least not in the first half, and there's a number of fundamental reasons, not just technicals, that support that statement. So when we look at silver, I've basically said silver never really got going, and silver was one of the leading indicators that I used to gauge the current weakness in the S&P 500. That continues to play out. We are not even remotely oversold. Using the predicted long-term difference, we have plenty of room to the downside. Now, natural gas is one that I do find interesting. It is oversold. It is grossly oversold, and I believe that if we see a bounce in any of the commodities, it will be natural gas before it will be gold or oil or any of these other things. Gold, 100% speculative. Natural gas is a commodity that we need. So when we look at these correlations, it looks like the dollar may have a pretty good year in 2012, but again, we have to worry about things like QE3. But even with QE3, I question to what extent it's really going to weaken the dollar. So from here, what we want to do now, we've looked at the correlations, and we've basically taken a gauge of the overall global economy by cross-referencing the US dollar to the metals, to the light sweet crude oil, and most importantly to the equities. So now what we do is we're going to go into the actual Forex. Now, looking at some of our Forex pairs, we look at starting with the Australia US dollar. Again, we're looking at a risk-based currency. They're all against the dollar. Forex trading, I tell this to my own clients all the time, that basically Forex trading is buying or selling US dollars. That's what it is. So based on the analysis of the correlation that the global markets have to each other, we're currently in a phase of buying US dollars. That's what we're doing. So looking at the Aussie US, we've closed the week at 99.72. Key levels 1.0067. I would be looking at selling into that area to start the week. Again, we're playing somewhat of a range here. We can identify it between 104 and down here around the 96 level. So we're pretty much smack dead in the middle of that range with a clear bias to the downside. We are a little bit oversold here on the US dollar, or excuse me, on the Aussie US. Predicted MACD and predicted TSI support further downside moves. So you can see that once I've done the correlation to the other markets, that I then come back to the Forex pairs with all of my indicators. Now I can put all those other indicators on the other markets, the commodity futures, the equity futures, but I think you get the idea is what we're looking as the overall correlation. When I look at the New Zealand US currency pair, I see the exact same thing. The key level here, 76.49. Again, a good selling opportunity into this level with a close of 76.05. I believe that risk will be off for the